and acknowledge that. And let me slowly put my computer into tablet mode, because if I do it too quickly, it tends to have a freak show. Okay, good. I do most things slowly, so I don't see why it's perceiving me as doing that quickly, but okay. All right, good. So let's go ahead and pick up now revenue recognition part 2. And as you can tell by the word part 2, the phrase part 2 here, it's really a continuation of what we had started to talk about last time with revenue recognition. Now remember, we had the 5-step process, and remember that one of the key takeaways from that discussion was that, hey, even though we're calling it a 5-step process and formalizing some things, it really comes back to some things that appeal to our, and I'm going to say in our accountants' common sense, and that, a kid riding a skateboard wouldn't understand what we're talking about when we say, well, you haven't performed a service, so it's not under revenue. But common sense in terms of us having been around accounting for some time now, we could sort of leverage off of that in applying that 5-step process. So we're going to continue in that vein, although we are going to call out some specific things addressed by the standards when it comes to revenue recognition. So let's just go ahead and continue that. And we're talking about here the incremental cost of obtaining a contract. Now, all we're really getting into here is if you have to incur costs in order to secure the contract, well, you can capitalize those costs and then amortize them over the life of the contract. If you would have incurred the cost anyway, regardless of whether you got the contract or not, then the requirement is that we simply expense that cost. Okay, so let's just take a look. The incremental cost of obtaining a contract, or cost incurred that would have been incurred if the contract had not been obtained, and therefore should be capitalized as an asset. And then, of course, like all assets, except I guess maybe land and goodwill, should be amortized. If the entity expects that it will recover these costs, an entity will recognize the expense. If the entity expects it will recover these costs, that's part of that last sentence there. Gets confusion there. Keep that yellow. Okay, and then an entity will recognize an expense if the cost would have been incurred regardless of whether the contract was obtained. So you look at that and you think, oh, wow, that's a real, complicated rule. And if you think of it from a standpoint of an accountant, it makes complete sense, right? So let's just look at this example, though. We have this software developer enters into a contract with a customer to transfer a software license, perform installation, provide updates and technical support for 3 years in exchange for $240,000. In order to win the contract, the developer incurs the following costs: legal fees to draw up the contract. Well, look, you're not going to drop a contract unless you know you have secured the contract, right? So that's something that's probably going to be able to be capitalized, right? Travel costs to deliver the proposal. Well, look, that's just a shot that you're taking, and that cost would be incurred whether or not the contract was actually completed. Commission to the sales employee, well, you're only going to pay that if you actually what? If you actually get the contract. So you take a look at the solution here, and the travel cost should be expensed because, it wasn't a guarantee that you would get the contract. Meanwhile, what? The legal fees of $10,000 to draw up the contract and the $12,000 commission should be recognized as an asset because you only incurred those costs as a result of having, secured the contract. Okay. All right. So pretty straightforward stuff, even though they give us a lot of formalized discussion there in that paragraph at the beginning, you probably could have figured that out without even, reading that first part, right? Okay. But let's take a look at costs to fulfill a contract. Okay. And the costs that are incurred to fulfill a contract are not within are not within the scope of another standard will be recognized as an asset if they meet all of the following criteria. Okay, so they're saying that there are some costs that might fall under the scope of another standard. So you follow the rule of that other standard for some of these. But let's just go ahead and flashcard all of the following criteria. I tend to flashcard all of the following criteria type questions because I can see somebody saying which of the following would or would not apply. And it's nice to have that flashcard with you on the day of the exam, not in the exam site, of course, but on the day of the exam. You're supposed to get there an hour early prior to the start of your test, do one more round with your flashcards, all those final review steps that we talked about in the How to Study document. But the costs have to meet all the following. They relate directly to the contract, okay? Direct materials, direct labor, obviously. They generate or enhance the resource of the entity, and they are expected to be recovered. And of course, costs that are to be expensed include some items that would be expensed in any situation, which is including general and administrative costs. Those are period costs. Wasted labor is a period cost, etc. Okay. Okay, good. You can go ahead and flashcard that last paragraph there if you want, that last little baby paragraph sentence, whatever, you can flashcard that as well. Okay.
What do they mean by costs tied to satisfied performance obligations? Do they mean something that was already satisfied? Is that what they mean?
No, I think costs tied to satisfied performance obligation would be if I'm going to have to provide some sort of service under that, I'm obviously going to expense the salaries associated with that service person. So costs that I have to incur to complete my obligation under the contract are going to be expensed as I incur them under the matching principle, right?
Okay.
Okay. All right, good. Let's look at principal versus agent. Okay. And what they're really getting into here is this notion that many services today, you simply have a company that sets you up with the service, and then another party provides that service. And the classic example is Uber, right? What happens? You simply use Uber to get on their platform to order your driver. And after that, it's between you and the driver. So in that situation, Uber would be the agent and the driver is going to be the principal. And so we're going to see how we would structure the recognition of revenue if I'm the agent versus I'm the principal. By contrast, let's say you go to Nordstrom and you buy a shirt for, whatever ridiculous price Nordstrom charges you for a shirt, $50. And let's say that shirt costs Nordstrom $10. Well, in that case, Nordstrom is what? The principal, because they had the inventory, they sold you the inventory. If you get the shirt home and you discover, there's something wrong with it, you can take it back to them, etc. Okay. So let's take a look at whether, and now in more formal terms, okay, whether or not an entity is a principal or an agency. The entity controls the goods or service before it is transferred to the customer, the inventory, right? When this is the case, the revenue recognition is equal to the gross consideration an entity expect to receive. So just going back to my example, if the shirt was $50, let's say, then Nordstrom would show and I'm going to go ahead and put Nordstrom over here. Well, I don't have to put Nordstrom, I'll put principal. Let's do it that way. So I don't have to get permission from Nordstrom to use their name. Okay, so we have, I'm just kidding, but the principal, right? Sale, $50, okay? The cost of goods sold, I don't know, $10, let's just say. And then they've got a gross profit on that of 40, right? So they recognize the sales price, they take off the cost of that. Now, if we are an agent, the entity arranges for another party to provide the good or service to the customer. When this is the case, the revenue recognition is equal to the fee or commission for performing the functions. So what happens? Let's say Uber charges you $2, and then the cab driver is going to charge you whatever they charge you for the ride. So if we were the agent now, if we were Uber, our sales, whatever revenue, would be $2. The cost of the goods sold is what? 0. And the gross profit on that is what? Is $2. Okay. So taking a look then, how will I know if I am the agent or if I am the principal here? Okay. And to determine that you are an agent, this is the criteria for agent here. Okay. That we're an agent. There it is. Okay. Flashcard. Another party is primarily responsible for fulfilling the contract. That would be the driver. The entity does not have inventory risk. They don't have any inventory risk. They're simply letting you use their platform to order the driver, right? And the entity does not have discretion in establishing prices for the other party's goods or services. Well, you know, how much someone can charge you to take you to point A and point B in a city is sometimes, in many cases, up to city statute. You ever get in a cab, they'll tell you this is how much they're allowed to charge you to go these different distances. Okay, so flashcard those criteria to determine whether or not somebody is a agent. And then I'm not going to go through that example because I like mine better. I gave you an example. Okay. All right, good. Let's take a look here at repurchase agreements. Okay. And we start to get into some minutia here. I mean, I could see the examiners maybe asking you 1 or 2 questions here about repurchase agreements. Okay. But essentially, what I have is a product and I sell it to my customer. And then there's some kind of an agreement that will either require me to repurchase that or give me the opportunity to repurchase it, or maybe allow the customer to make that decision at some point in time down the road. So a purchase agreement is a contract by which the entity sells an asset and promises or has the option to repurchase the asset. Okay, now there are 3 main forms that we're going to talk about here of repurchase agreements, okay, which includes the entity's obligation to repurchase and very, you know, again, the reason I'm sort of calling this a little bit minutia, very technical term here, very jargonistic term, that's a forward, okay, or an entity has the right to repurchase. And if I have the right to repurchase, that is called a call option. And if I have the obligation to repurchase that at the entity's discretion, then that is called a put option. Okay, so 3 different opportunities here. Let's look at forward or a call. Okay, and how we treat it is going to be entirely predicated on whether the repurchase price is more or less than the original sales price. Okay, that's going to be what determines. Okay, so the entities accounting for the contract will be on whether it must, in a forward or call, repurchase the asset for either less than the original selling price or equal to, I left out equal to, in my little synopsis there, equal to or more than the original purchase price. So if it is less, then it is treated as a lease. Okay, now flashcard that requirement and just put down chapter 5, because we're not going to talk about lease accounting here. We're going to talk about it in chapter 5. But when you think about this, this makes sense. If what? I have to repurchase it from you, but it's less than when I originally sold it to you. The FASB is looking at that and saying, well, that's kind of like you leased it to them and then it came back to you at some point in time, right? Okay, so they tell us to treat that as a lease. If it's equal to or more than the original price, then it is a borrowing, it's a financing agreement. And just think about that. I sell you something for 100,000, right? And there's a forward or call option that says that I have to repurchase it from you for 150,000. Well, you just lent me money. I sold you equipment, you got to use it, and then I have to give you more money back than what you originally gave me. That's essentially borrowing money, okay? So you take a look and flashcard that if it is a financing, and again, whether it's a lease or financing depends on whether we're buying it back for less or more than the original price. If the contract is equal or more and it's a financing agreement, then the entity will recognize the asset, recognize a financial liability for the consideration received, right? Because I'm going to give it back to them, and interest expense for the difference between the amount of consideration received from the customer and the amount of consideration to be paid by the customer. So if I have to pay them more than what they originally gave me, that's interest expense, okay? So let's just go over and let's just
about which way that's going.
Let's look at the example first, please, and then you can ask the question. Okay. So let's just take a look at this example. And on January 1st, Anderson Company enters into the contract with Tanner for a sale of an excavator for $350,000. The contract includes a call option that gives Anderson the right to repurchase the excavator for $385,000. Okay, we're more, so we're in the financing agreement scenario, right? Tanner pays the entity $350,000 on January 1st, December 31st, and the option lapses unexercised. Okay, so what happens? Okay, they got the $350,000 cash, but because they have the option to repurchase, that's a financial liability because there's a chance that they will be giving this cash back to the purchaser. Okay. Then what happens? During the year, Anderson recognizes interest expense of $35,000. That's the difference between what they would have to repurchase it for and the original money that they got. Then what? Then the contract expires and they don't repurchase it. Well, then they can go ahead and debit that liability, and it's for the entire amount, $350 plus $35, and now they can credit revenue. Now, of course, if they repurchased it, okay, if they exercise the option, I'm going to put if exercised here, assuming I can spell exercise, then of course we would credit what? We would simply credit the cash. Okay, go ahead, Kathy. You had a question?
I didn't really understand which way this was going. It sounds like you're selling something to somebody and then you're agreeing to buy it back for more than you sold it to them for, but they only give you $350 in cash, and then you're recognizing $385 as revenue. I was very confused about what this transaction actually was. Well,
I sold them something.
Right.
But there was a chance that I was going to have to repurchase it, or decide in this case to repurchase it for more than what I sold it to him for. Well, that's borrowing money, especially if it's a forward.
Okay.
If they're going to force me to rebuy it, then that's borrowing money. If someone has the right to force me to give them their money back, then I'm borrowing money from them. In the eyes of the FASB, I don't know.
Okay. All right.
Differ, and I didn't read the dissenting opinions on this, and I don't know if it passed 7-0, 4-3. I met with the FASB one time, and I had to stop them from beating each other up. No, I'm just kidding. I didn't have to, but you meet with them, and you can't meet with all four at one time because they could set policy in that meeting. So when we met with them, because Congress wanted to understand the standard setting process, and you meet with 2, you can meet with 3, you can meet with 3 of them plus their staff, but you can't meet with 4 because they could set policy in that meeting. Okay. If you're going to do something else during the class, you might want to not have flashing lights sparkling all over the place, or because it's obvious that you're watching the fireworks show instead of paying attention to the class. Okay. But anyway, what happens is there are times where my students will say to me, the point of this story is my students will say, well, that doesn't make any sense to me. And then I've looked and I'm like, well, yeah, you know what? You have the opinion of 3 of the 4 members of the standard setting body, but they lost in a 4-3 vote. Okay. So sometimes your instincts are good. So we have to kind of, suspend those a little bit to help us with the understanding, which is notion is if you're going to have to, you can force me to give you the money back. Then in effect, what's happened is I've borrowed money from you. And if I have to buy it back from you for more than what you had originally loaned me, well, that difference is interest. And so they're treating that amount as interest expense here. And then finally, we satisfied that liability by letting the option lapse, in this case, unexercised. And so now we finally can take the revenue because we have completed the performance obligation at that point, right?
Okay. All right. Thank you.
Yeah. Again, I want to stress here, because I kept talking about the common sense part, and I didn't mean this to apply to this. No one wakes up in the morning and says, oh, okay, well, if you're done, you lease it, then you borrow, that's a financial liability. I mean, this one you're going to have to kind of cram into your head and just make those flashcards. Okay. Okay, good. If it's a put option means they can make the decision. Now it's putting the decision in the hands of the purchaser. So if the entity has an obligation to repurchase the asset at the customer's request for less than the original price, it is a lease. Again, we'll talk about leases in chapter 5, or it could be seen as a sale with the right to return. Flashcard that makes sense, that if at some point in time they can force me to take the thing back, okay, sale with the right to return. Okay, if the purchase price is equal to or greater than the original selling price, then it is a financing agreement, just like we said for the forward or the call option, or it could be a sale with the right to return. Okay, so just flashcard the requirements here. I don't think you need to be worrying about, this is one, if you don't mind me saying, Autumn, you could work on these kind of questions here. You could probably work while you're on your exercise bike or something. I don't expect a whole big bunch of number crunching on these, and that's why I just have you flashcard the concept. Okay. All right, good. So I'm not going to go through this example because at the end it just says, okay, it's a put option, so you should treat it as a financing agreement or something. I don't know, whatever they say there, I don't care. Okay. All right, let's talk about bill and hold. Okay, what happens here? Well, if you buy something from me and you ask me to hold it for you as an accommodation, okay, and I hold that thing for you as an accommodation and I put it aside, is that a sale, do you think? You tell me, please hang on to that because I'm not ready to take delivery. Hold it for a couple days for me because I don't have a delivery truck big enough to pick that up.
I think there's some criteria to that. Like, is it specifically set aside for that customer? Can it be available to other people?
Well, you're going through the criteria. That's listed below from just your maybe study of business law or something, right? Okay. And so, but from a common sense standpoint, you asked me to hold something for you because you're not ready to pick it up. And let's go ahead, Matthew, and add to the scenario. I put a sold sign on it. I can't sell it to anybody else. People keep coming in and saying, well, that's the most beautiful bookcase I've ever seen. Are you kidding? And I keep saying, no, that's Matthew, sorry. And I don't sell it to anyone else. And then you come and pick it up a couple of days later. So I sell it to you December 31st, you pick it up January 2nd. Okay. Is that a sale at December 31st? Do you think?
Yes.
Yes, it is. Okay. So it's kind of like Think of it. If this happened, if you were in this scenario, when you came back and the dude sold the thing, you'd go to Judge Judy and say, hey, he sold my bookcase, whatever, right? Okay. Okay, good. So let's just take a look then, see what they tell us about these bill and hold arrangements. Okay. And there must be a substantive reason for the arrangement. Mainly, the customer has requested the arrangement, say, because it doesn't have space for the item, but the customer has requested it, and it's okay to still recognize this sale if the product has been separately identified as belonging to the customer, the product is currently ready for transfer to the customer, and the entity cannot use or direct the product to another entity, right? So you don't expect, if I put your motorcycle aside, you don't expect to see me, you know, going by the next day. Wait, well, I saw Lord on my motorcycle. He's supposed to set that aside for me. No, right? Okay. Okay, good. Come over. We don't need an example. When I look at some of their examples, guys, I just go by them here because these keep getting into that excavator, and who ever thinks of an excavator? Just think of it as something, you know, like a table or a bookcase or a motorcycle or something that you would be dealing with on that. Okay. Okay, good. Let's come over and let's take a look at consignment. Okay, so what happens here? Let's say after you pass the 4 parts of the CPA exam, you decide you're going to write a book about your experience, and you write a book entitled Mothers Don't Let Your Children Grow Up to Be CPAs. Okay. Now, what happens? You go and you're trying to get, you know, bookstores to buy that book from you and have it as part of their inventory. Are there any bookstores left? Is Barnes & Noble still around? I know, because I'm going to assume they're the one last remaining bookstore on earth. Okay. So Barnes & Noble, you go to them and they say, we don't want to take any inventory risk on this, but they take pity on you and they say, look, here's what we'll do. We'll let you put a display in our store, and we'll put a cardboard cutout of you there. And look, if someone buys your book, okay, we'll remit the funds to you, and we'll keep a small percentage for our trouble. How about that? Okay. And you decide to do that. Okay. Now, end of the year comes. Should those books be included in your inventory or Barnes & Noble's inventory, do you think?
My
Inventory.
In your inventory, because Barnes & Noble is just letting you hold the stuff there, right? Okay. And when the third party buys the book, then you take the sale, and of course you would net off the cost associated with that sale, which would be the fees you have to pay to Barnes & Noble, right? Okay, good. So let's just take a look at how that works. Consignment is when the dealer or distributor has not obtained control of the product. That would be Barnes & Noble. Revenue is recognized when the dealer or distributor sells the product to the customer, or when the dealer or distributor obtains control of the product. Okay, so we're not going to take any revenue in that case until what? Until Barnes & Noble has finally sold that book for us, and then of course they'll probably take some commission. Okay. Okay, good. Come over. We don't need another example. Let's talk about warranties. Okay. Now, again, guys, I'm trying to put these in context of maybe an experience you've had. You know, when I'm going to use an example, Best Buy here. You know, Best Buy knows, they know me by my first name. Or they come in and say, oh, hi, professor. Okay, because every time they see me, they know I'm coming in and I got to buy them. I need another. This thing's not working now. I need another one. I need my TVs. Okay, so when they see me, sometimes some of the salespeople, you see them heading towards the back when they see me coming in. Okay, so what happens? Every time I buy something, they say to me, would you like to buy the extended warranty? And I always tell them no. Okay. But what would happen if I bought the extended warranty? Do you think that's a separate obligation for Barnes & Noble? Yes, it is. Okay, so if the warranty goes beyond that sort of, manufacturer warranty for 1 year, this kind of standard stuff, and it starts being a warranty that goes beyond that, that is extended, then the entity has to separate the sales price out between the two performance obligations, the sale of the product and the sale of the extended warranty. Okay, that's where we're going with this. Okay, so let's take a look. The accounting for warranty will depend on whether the customer has the option to purchase the warranty separately. You know what? Just flashcard that, because that's a very obvious, simple thing that everybody understands that will just trigger what you're supposed to do in these cases. Okay, but let's just go ahead and continue reading a little bit more. If it can be purchased separately, the warranty will be considered a distinct service because it's promised to the customer in addition to product covered by the contract. The entity will therefore account for the warranty as a performance obligation, allocate a portion of the overall transaction price to the obligation. If the warranty cannot be purchasely separate, then there's no separate performance obligation. Guys, save yourself some, hand cramps and just write that first part on the flashcard because it says it all right there. Okay. Now, let's take a look though at the following factors that will indicate whether it is a separate performance obligation. And yeah, let's flashcard those in case a question gets a little more descriptive instead of prescriptive in what they're asking you. And then, we might be sitting there wondering, well, does that indicate that it is a separate? So if the law requires the warranty, this would indicate that it is not a separate performance obligation. The longer the period, the higher the likelihood that it is a performance obligation. What I don't like about this flashcard is they kind of float in and out, and it is not, it is. So sometimes I like something to just all be on one side of the ledger or the other. They kind of float back and forth here. But anyway, if an entity must perform specific tasks to provide assurance regarding the product compliance with agreed upon specifications, then the tasks are not likely a performance obligation. So if it says, hey, this thing has to withstand so many hours of use or something, and that's what's covered by the warranty, then it's not a separate performance obligation. Okay. Now, if the warranty provides a service that is beyond the assurance of the product will comply with agreed upon specification, the promised service will represent a performance obligation. Again, we have to allocate the transaction price between the two. Okay. Okay, good. So, when you go in and they offer you those things that you reject all the time, that's because they're trying to generate new revenue beyond what they're getting there, right? I mean, that's pretty much what they're doing. I did buy from Best Buy a deal. I couldn't believe that they have this deal where you pay them $100 and then all your devices you can bring in. I don't know if they realized who they were selling that to, okay? Because I show up with all kinds of things. Like I said, that sometimes I see them going out the back when they see me walk in. Okay, refund liability, okay, and the right to return. An entity should recognize a refund liability if it receives or will receive consideration from a customer if it anticipates having to refund a portion or all of the consideration. Okay. Now, the way they've shown this, okay, we'll have an asset related to the subsequent recovery product when the refund liability is settled. And you can go ahead and flashcard that. We recognize a refund liability and asset related to subsequent recovery products when the refund liability is settled. In other words, it expires without consequence. But the way they've shown this is a little bit bothersome to me. I guess it's technically okay that they set up a refund liability when they have determined that 10% of their sales come back in the form of a refund. Okay. And then if somebody comes back and they return $3,000 worth, you debit the liability, you credit the cash, okay? I guess you could do this, but the problem I have with this is this to me flies in the face of good product management, because if you do it like this, then it's a little difficult to really determine what product was returned, et cetera. I mean, you're kind of, limiting your visibility as to what got returned if you simply do that, and it's not going against any kind of sales return account. So the way I would have thought this would have been done would be to debit the cash for the 50,000. Obviously, we agree on that. And then I would have gone ahead and just credited the sales gross for 50,000. And then there's nothing in the accounting rules that prohibit me in a situation like this from debiting my sales returns for 5,000 and crediting that liability, refund liability, whatever. For 5,000, that's a credit. Okay. And then if you think about it, when we prepare our income statement, I'm just going to erase that arrow. The sales would be what? 50,000. The returns, which is an estimate, it's estimated returns, would be what? 5,000. And we would have net sales of 45,000, right? Which is sort of what they ended up with here. But I like this extra journal entry here, because now at a subsidiary level, when something gets returned, I can keep track of what got returned. If they just deal with this liability, unless they somehow have the debits to the refund liability lined up with their product sales, but that doesn't seem very likely to me. It seems like you'd want to do that more in your sales accounting ledgers, systems. And then of course, yeah, if there's an actual return now, then then you can go ahead and you can debit your your estimated sales returns. So this would be estimated sales returns. And that's what you can go ahead and then credit your estimated sales returns. And
so the way you're suggesting doing that, is that like a contra revenue account, or what type of account is that?
Okay, let me finish my journal entry here. Okay, so I would go ahead and credit the estimated sales revenue for 3,000. I mean, sales returns, excuse me, and debit sales returns for 3,000. And then when I report, and if I have this estimated returns, it was originally 5. Yeah, I debited originally for 5. And I credited it for 3. So it has a balance of 2. And then my actual sales returns is showing what? The debit of 3,000. And then Kathy, this account that I report on my income statement, I probably wouldn't even present that on my income statement, to be honest with you. But yeah, it's seen as a contra sales account. Most companies are going to just start with net sales, aren't they? Okay. All I'm indicating to you here is we have a problem with this abbreviated. I think they did it this way because they're simply trying to get you to focus on the liability. And all I'm pointing out to you is if you sat there and did it this way, well, then you lose what was the actual returns on your sales. Whereas here it's right there. So that's all. I'm just pointing out that when I look at this, I'm like, huh? Who would do this? Most entities are going to keep track of their sales return because they want to know if entities are returning their sales. But to answer your question, yes, this technically is called a contra sales account. Okay.
Crediting cash, because when you refund somebody, you're giving them cash back.
Yeah. Well, they gave me cash. They paid me in cash.
Yeah. So in your journal entry, I don't see the credit to cash.
Right here.
Oh, you're including.
Yeah. Correct. Correct. You would do this. You would do this upon the return.
That makes sense.
Yeah. Okay. I'm just, there's nothing I disagree with here, I guess, in terms of final outcome of the journal entries. I just added some accounting here that I think is pretty common. Okay. All right, good. Let's just go ahead and let's take a look at this multiple choice question, and let's see if we fix the poll problem. Can you see the poll?
Yes.
Yep.
Okay, it makes no sense. I have to go to my monitor computer to launch the poll. It won't let me. Never mind. Not your problem. And guys that haven't been to class before for polls, guys, we're given generally what? A couple minutes, right? For the poll, okay, to complete the poll. Sometimes I'll give you more if the question has more calculations, but usually about 2 minutes. Okay, guys, let's go ahead and take a look at this one. And looks like about 78% of us got it correct. The correct answer here is A. But let's just go ahead and take a look at this one. And I want to get this poll out of the way. Is the poll out of the way now?
Yeah.
Okay. Okay, good. So let's just take a look at this one, and this Joho Roasters manufactures and sells coffee bean roasters. Joho entered into an agreement with Smooth and Bold Coffee to manufacture 5 roasters for S&B's new production facility. The roasters were manufactured to S&B specifications, were completed on September 1st, year 2. Okay, so there's a date that we're going to want to think about since we already know that's the right answer. Due to delays in the construction of S&B's new facility, Joho agreed to maintain the coffee roasters in a separate section of the warehouse until the S&B facility opened in January. S&B paid for the roasters on October 1st, year 2. On which date should Joho recognize the revenue? Well, looking at this, they're holding those roasters at their request. So the fact that they delivered it into the next year is of no consequence. December 31st, I don't know why. What would be the difference anyway if they did it on September 1st or December 31st? But there's absolutely no logic to December 31st. October 1st, well, no, we recognize sales all the time before we're paid cash, aren't we? That's called accrual accounting. Okay. And so what? The day that we were ready to deliver those roasters, whatever, and then we waited for some time as an accommodation to the customer and set those aside, et cetera, that qualifies as a building hold. And so we would take the revenue September 1st. Question?
So they didn't give us the date that they actually entered to the agreement. So, but even if that was like August 15th, for example, the answer still would have been September 1st, correct? Because that's when it's available for sale.
Yeah. Oh, yeah. Because the day that we entered in the agreement, we still hadn't delivered anything, right?
That makes sense. We haven't performed our obligation. Gotcha.
Yeah. Correct. Right. Entering into an agreement generally doesn't generate a accounting entry. Okay. Now, where we start having accounting entries is when one party or the other starts to act on that agreement. So, Matthew, let's say they gave us the money in advance of this September 1st on the date that we entered into the agreement, your example, August 1st, whatever. Well, then we'd have to debit cash and credit unearned revenue, right? And we couldn't take the revenue until September 1st. But just entering into an agreement where there's no financial consequence doesn't generally create a journal entry.
Got you. Yeah, now that makes sense. That's module 3. That's what we talked about last time.
Yeah, no, that's all right. You know, I've only been teaching the CPA exam for 25 years now, right? So I'm just getting used to this stuff myself. Okay, so is it 25 years? 1991? Oh no, 1991 to 1995 to 2021. How many years is that? Yeah, I guess it is 25 years. Okay. Where have all its good times gone? Okay. Anyway, let's go ahead and let's take a look at long-term construction contracts. Okay. Now, here's what's going on. There was a time in accounting where we had an option between completed contract method and percentage of completion. Okay. Now, when FASB came up with these rules of saying, hey, you can recognize the revenue over time as you start to deliver the product, and you're sitting there and you have control of the product, and I can't direct it to anybody else. And they came up with all of these rules, and then they looked at contract accounting and said, well, completed contract method is dead then, because you can look at the construction of, say, a building, and it's not like I can take your building that I'm constructing and direct it to somebody else, et cetera. So they're looking, saying, well, that meets the revenue recognition over time criteria. So we better say that companies are to use the percentage of completion method. Okay. But they held on to the completed contract method. So we still have to bother ourselves with it in the case that we don't have a good way of estimating our progress towards completion. Okay. So the rule is you should use percentage of completion unless you have an issue in terms of estimating your progress towards completion. in which case then you would use the completed contract method. So they kind of changed and said, well, you should use percentage of completion, but you don't have to use it, okay, if you can't reasonably estimate profitability and provide reliable measure of progress towards completion, okay? Now, under the percentage of completion method, what we do is we will basically figure out what our income is that is recognized for the period by looking at the incurred cost to date and comparing that to the total estimated cost on the most recent cost information. So we're going to use engineering estimates, and we're going to compare the total cost of the contract that is estimated the cost that we've incurred to date. And that's the percentage that we will indicate done. Okay. And again, you have to have some reasonable way of estimating that. You know, I would be a little bit worried if I was constructing a building and I had no way of telling you what the total estimated costs were going to be versus how much I've actually incurred to date. But they leave that as a reason to use completed contract. I don't know. If I was auditing somebody and they're a construction company and they sat there and they told me that's the reason they're using completed contract, I'd have some concerns. Okay. Now you take a look and we start to talk about the balance sheet presentation. Now let me stop and tell you that most questions are going to focus on the income determination. You will probably see one maybe question that asks you the balance sheet presentation of a contract as it's going on, okay? Now, what we have are current assets or current liabilities here, okay? So we will always have a due on accounts receivable, okay? And that's obviously a current asset. And you always have that as to whether or not you're going to report this second part, which is going to be a current asset or a current liability, okay? The current asset is called construction in progress. The current liability is called, and it's very descriptive, progressive billings in excess of estimated earnings on uncompleted contracts. Now, let's just go ahead and put in a scenario here because the way this is written, I don't see how anybody on earth would understand it. So let's just put an example in, okay? So let's say we're sitting here and we have a contract and we have costs, and the costs that we've incurred so far are $1 million. Just saying cost incurred, just to make that clear. Or say $1 million, okay? Meanwhile, we've billed $900,000. So we've only been able to bill up to this point less than our cost, haven't we? Okay, so what do? Under that scenario, we will have these two current assets that are listed. One current asset will be accounts receivable, 900,000, because that's what we've billed, right? Okay, the other current asset is going to be what? Construction in progress. Which is going to be 100,000. Right? That is the what? That is the excess of progressive billings, excess of billings in excess of cost, sometimes called construction in progress, 100,000. Okay. Now, the other scenario that they're talking about here, okay, and let's just go ahead and say our costs are $1 million. But in this scenario, now we have billed 1.2. So now, and again, I said it's a very descriptive account. We've billed more than our costs, haven't we? Now, guys, and this is why I give you this example, because the way they presented this, it looks like you only have the accounts receivable under the current asset scenario, but no, since we've billed, we'll have accounts receivable of 1,200,000. That'll still be a current asset. Accounts receivable is an asset, current asset. And then in our current liabilities, we'll show what? I'm just going to abbreviate this to billings.
Billings in excess of cost for 200.
Good. Billings in excess, and I'm just going to kind of abbreviate it. It's that account. Okay. Billings in excess of what? 200,000. Good. Okay. That's what that thing is trying to say. Okay. Not a very good right up there, but I think we cured that problem with the example. Okay.
This is done per contract, isn't it? So if you look at because when you look at a contractor, a construction company's financial statements, you typically see both billings in excess of costs and costs in excess of billings, because they've got some contracts going one way and some contracts going the other way.
Oh, really? I don't know.
Yeah.
Yes.
So you'll typically see, particularly like somebody that's doing commercial construction, you'll typically see on their balance sheet both, because they've got a very detailed schedule, usually stuck at the end of the report, that details all that out, because lenders and underwriters, bonding underwriters want to see that.
Okay, well, that's flying in the face of what you're saying here. So I don't know if they're doing some sort of
they're assuming this is a one contract company, because this is a textbook example.
Well, no, because that would, if they were making that assumption, that would be, if it was a one contract situation, then why would they say that? Because it can't be both on any one contract. You can't have billings in excess and.
No. What I'm trying to say is that's done per contract, because you'll have some contracts that have billings in excess of cost net, and some that have costs in excess of billings net. And so on the balance sheet, you'll see both.
Right, but then the book is saying the two accounts are netted against each other for balance sheet reporting, which to me means they're going to balance that liability and that the current asset for multiple contracts, for more than one contract. And you're talking about a bunch of things that different people want to see. And if that's the case, that could be some sort of agreed reporting format. I don't know that that's a set of statements that are following general accepted accounting principles is articulated by FASB or not. So I don't know. My sense is that they would net them against each other, and then the book is kind of affirming that. So I would take another look at that, and then we can have a sidebar on that at some point to understand why you're seeing both of those. This seems to indicate that they would be netted. If you had more than one contract, of course, you'd have one or the other if you only have one contract. Okay, let's go ahead and let's take a look at revenue recognition here, okay? And when you take a look at the revenue recognition, that's the focus of the exam, right? Okay, how are we gonna recognize the profit on this contract? So let's just go ahead and flashcard these steps. These steps were in the course when I took the course, and I'm telling you right now, having these understood are the way to answer almost all the questions in this area, okay? So let's just take a look, and we have what? We have to compute the gross profit, and that's an easy step. It's the contract price minus the estimated total cost is the gross profit. To determine what percent done we are, remember we said cost to cost, the total cost to date versus the total estimated cost of the contract. So if the total estimated cost of the contract is 500,000 and we've incurred 100,000 of costs, we're 20% done. The estimated cost of the contract is 500,000, and we, got 250,000 of costs, we're 50% done. It's that simple. Okay. Now, what happens? We then have to figure out what has been the total profit earned to date, which they're abbreviating PDT here. And that's simply taking the total profit that we are estimating on this contract times the percent done we are that we calculated in step 2. And then to figure out the profit for the current year, we simply do what? Take the total profit to date that we got from step 3 and subtract the profit to date that had been recognized at the beginning of the period. That remainder is attributed to the current period. Now, we're going to see the same thing for the completed contract method here in a little while, but it's important to remember that losses are always and forever recognized immediately. And if you've taken profit in previous periods, you will literally have to take a big enough loss to wipe out any profits that had been taken in previous periods. So let's just look at this example. And this example is a very good example that has been in the course for years. Okay. Now, I'm going to mark this up as I go along so we can follow the numbers. Please do not mark up your text as I do, because it's going to turn this into an almost impossible to read example. As you'll see after I mark it up, it looked like a spider on crack got a hold of this thing. So just be careful. Don't mark it up as I go along, and you'll be able to follow through this example later when you study through it. Okay. So what happens? We're sitting here and we have what? We have sales price on the contract. Okay. We have total estimated cost. This is at the time that we kind of signed the deal, et cetera, of 3 million, whatever. And so we're thinking that our gross profit on this is going to be $1 million. Now, what happens? In year 1, we've incurred cost of 1.5. We think the total cost of the contract is going to be 3 million. So based on our cost to cost calculation, we determine we are 50% done. That means that we have earned what? 50% of that $1,000 profit or $1 million profit, whatever it is. We've taken what? We can take 500,000 of profit. Okay. Now, since we haven't, under percentage of completion, since we haven't recognized any profit in previous years, this is the first year of the contract, we attribute that entire 500,000 profit to this period. All right, that gets us through year 1. Year 2, contract price doesn't change, guys. Contract price stays the same throughout. Okay, this is not some sort of government contract where it's cost plus. They just keep adding on to the price of the contract as they have overrun on the original price. Okay, it's just for $1 million. And then what? Then we have the estimated cost 3.2. Okay, it can happen. We thought it was 3 million, now it's 3.2. So now we're thinking our profit is 800,000. Now, if you look at the fact pattern up here, that's where the 3,200 came from, by the way. And now they're telling us cost incurred to date are 2,400. So now with our new cost estimate of what, 3,200 as our denominator, our numerator is the cost that we've incurred to date. So now we're thinking we're 75% done. We're thinking our profit's going to be 800,000 on that. So we think the entire profit on the contract will be 600,000. But we already took what? 5 in the previous year. So now we're saying, hey, of the entire 600,000 on that contract, we've earned 100,000 this year because we're attributing 500,000 to last year. Now we go through this contract and what? The total cost is estimated to be 4,200. Do we like this contract anymore from a business standpoint? Okay. So we're saying, we're going to lose 200,000 on this. Okay. So we don't sit here and start trying to calculate percentage, blah, blah. We say, look, we have a $200,000 loss on this thing. We have to recognize it all. But to get us to a $200,000 loss on this, we're going to have to what? Take out the $600,000 of profit that we had recognized from the previous 2 years, okay, right there. So we have to take a total loss on this of 8. When we do that, that reverses out the $600,000 that we had taken from the previous 2 years and gives us now the $200,000 that we're saying we are going to lose on this contract. So under the completed contract percentage of completion method, we sit here and we have to take that 800 loss. Notice now that under completed contract, we weren't taking any profit, but losses always and forever are recognized immediately. And then finally, we end up in the last year of this contract losing $300,000. We know we have to take that $300,000 loss. We've already taken 2, so we attribute $100,000 to this year, and completed contract also recognizes that loss as soon as they realize it. Question?
I feel like I have questions, but I'm too confused to ask the question, so I'll have to look at it again.
Well, what are you confused about?
I'm not even sure.
You're not going to see me in a dream somewhere, are you? I'm not going to show up in your dream and say, oh, now, Matthew, that you had more time to look at this, what's your question? So I'm here now. Ask me the question.
I'm really not sure where I got lost, to be honest with you. I think it was around year 3.
Okay, well, do you understand that the profit on the contract in year 1 was an estimated $1 million?
Yes.
Do you understand that we were 50% done, we thought at that point?
Yes.
Do you understand that that therefore allowed us to take 50% of that profit?
Yes.
Do you understand that we hadn't taken any profit in previous years?
Yes.
So then you understand why we took 500,000 for year 1.
Yes.
Okay, in year 2, and I'm not going to go through every single one of these, but same thing. Now we think we're 75% done. We took 600 that we think on the entire contract, we're going to make a $600,000 profit, right?
Mm-hmm.
But we already took 5.
Yes.
So we're only going to take 100 to bring us up to the 600 that we think we've earned so far, right?
Yes.
They call that change in accounting estimate. You don't go back and say, well, wait a minute. Last year, I said that the total cost is going to be 3,000 and now it's 32. So really my profit was only 80. So I got to go back and fix last year. If companies had to go back and fix their financial statements every time there was a change in estimate, all they would do is change their financial statements year after year after year. And that sound you hear would be what? Would be the markets losing faith in financial reports because the numbers change every time, right?
Yes.
Okay, so we don't have to do anything there. Okay, so then year 3, okay, where it gets a little harder to follow. Okay, in year 3 now, we sit here and we realize, hey, we're going to lose 200,000 on this thing. And we must take a total loss of 200,000 on this contract. But we've already got stuck in retained earnings, what? 600,000 of profit, don't we?
Yeah.
So to take out that 600,000 out of retained earnings and put what, a 200,000 loss into retained earnings, debit and retained earnings, we take a loss of 800,000, don't we?
Got you. Okay.
Now, retained earnings got a negative 200,000, at least from this contract, right? Which is what should be the case, because that's what we're thinking is going to be the effect on retained earnings on this contract, right?
Yeah.
And we take the entire loss. You say, but you're not done. Well, you got to take the entire loss at the time that whatever you think that loss is going to be. And then finally, when we get to year 4, we're done. We're done with estimates. Now we know we're losing 300,000 on this. We already took 200,000, so we only have to take the 100,000.
Got you. I guess somehow around year 3, I got lost of what that 800 was. I don't know how.
Yeah.
I followed it through 1 and 2, but I got it now.
All right. No, my only point is I want you to understand now while you're this close, and then over the course of a couple of days, you get further away from that understanding that you almost got right now. That's why I want to do it now. That's my only point there. And the reason I stopped and say questions, because I know that, you know, half the class didn't understand the example, so don't feel bad. You're just going to say something, Captain?
I was going to say, I thought that was the confusing part, the reversing out of the loss, because it doesn't relate, it relates to year 3, but it reaches back to year 1. That's what's confusing about it.
Yeah, well, that's how you're supposed to do it.
No, I perfectly get that. I'm not, I am
No,
not.
I'm just saying, I know it's,
yeah.
confusing, but our job is to understand it. And then you're going to find that this is one of the funner areas of your homework. As opposed to it being, you know, this drudgery. Oh my God, percentage of completion questions. Oh no, you know, what I think will end up happening is you'll be like, oh, okay, I like these. Okay. All right, good. Now let's go ahead and let's look at completed contract method. Okay. And guys, I'm going to just skip by this balance sheet stuff because it's exactly the same. In fact, let's go ahead and write that same as percentage of completion. So there's no need for us to repeat that. Okay. Now you come over and we are going to figure out the profit on the contract as we did before for percentage of completion, contract price minus total estimated cost. And we're not going to take any, under the completed contract method, estimated profit is not recognized each period unless there's a loss. Loss is what? Recognized immediately. We saw that in the example. That's it. Okay. All right. Take a look at, I'm going to skip this next page because they start calling out journal entries with no numbers, which does us no good. So let's just take a look. If they wanted us to consider journal entries, they should have given us some numbers there to look at. And I don't see questions that ask you a lot of questions about
Ask a question.
Yeah.
I just want to go back to the journal entries because I just, I'm not that familiar with journal entries, and I just want to make sure what type of account I'm looking at. And in particular, you see the big box that says journal entry to record estimated gross profit during construction. If I'm looking at the cost of long-term construction contract, for those two things, am I looking at inventory type accounts? Is that what I'm looking at for those two items that have debits, the cost of long-term constructions and construction process?
Cost of long-term construction progress, construction in progress. I think those are, this is an income statement account. This is an expense. And this is the asset, construction in progress.
Okay. So it's kind of like the accounting for the manufacturing thing where you're accumulating stuff in like in expense accounts, then it goes to manufacturing overhead. And then it goes to cost of goods manufactured. You know what I'm saying? Where the expenses go over to an asset account.
Mm-hmm. Yeah, because when I'm looking at this, the materials, et cetera, okay, are being recognized as construction in progress, right?
Yeah.
And then all we're doing here is taking in some of that profit into that construction in progress and recognizing the costs, and we have to have a matching against the revenue we recognize and the expenses today, right? For that determination.
Here's where I missed T accounts.
Yeah, well, again, if they wanted us to understand journal entries, they should have put some numbers on it, okay?
Yeah,
And,
exactly.
and I'm not gonna sit here and create a bunch of.
Okay, but that was helpful actually, because I was confused about whether I was looking at an income expense account or whether I was looking at a balance sheet account.
Right. I think we're best off focusing on the determination of the profit, okay? Because that's
Okay.
there. And I think when you look at most of the questions, that's what they're going to ask you. They're not going to ask you journal entries. They're going to ask you, can you determine the profit? And then they might ask you one or two questions about that liability versus, current asset versus current liability. So that's why I kind of focused on those things. But let's go ahead and let's take a second to look at, well, not a second, I'll give you some extra time on this. Okay, so the poll is up there, right? So I'm going to give you 3 minutes for this question since it is a little bit more involved, okay? 3 minutes, guys, by the way, is the maximum amount of time you should spend on any question on the CPA exam. Never spend more than 3 minutes. And I don't mean that you got to be sitting here with the stopwatch. You have a sense of when 3 minutes goes by. Never spend more than 3 minutes on any one question. They're not worth it. Some questions you can work in less than a minute. Some questions maybe a minute and a half or something. You want to average about a minute and a half, 2 minutes per question. You start getting into 3 minutes on a question, you're taking too long. Okay, all right, let's go ahead and let you take a look at this one. Okay, guys, we're well over 3 minutes and I'm getting 5 out of 13 participating. So what's going on? does you no good to come to class and not try these.
And I'm trying. I keep going back and forth to the thing because it was a lot to remember. And
Okay.
Yeah, I'm doing the same.
Okay, so you need more time, in other words. Okay, that's fine.
yeah, basically.
I'll give you more time. You will get very good at these. So when you are enjoying a little bit of relaxation time with your friends and family, you'll be telling them about how to account for construction contracts. That's what I used to do back when I had friends.
What's funny is when me and my wife go on walks with the dog, I actually do talk about this stuff just because I need to get it out. And English isn't her first language, so it adds complication to it.
Well, that means she really loves you. If you wake up in the morning and she's still there after a walk like that, stop, John. I'll leave. I'll stop there. I was married at one point in time. I got married. My wedding was the day after I took the CPA exam.
Oh no.
So, and then the marriage lasted 9 months. Now, don't let that discourage you from passing the exam. Okay. So with all that, okay, not exactly the results we're looking for here. Looks like some folks had trouble with this one, and that most of us got it right, but we're looking for better than 55. I like to see at least, 75% of the class get this right, right? But let's go ahead, and I'm going to take this off the screen here for us, and let's just go ahead and take a look and work this one a little bit together, okay? So you're looking and they want to know what is the gross profit that should be recognized in year 2. Okay. Now, my first job is to say, well, look, the first thing I'm always looking for in this is how much work have they done? How far done? I know I got to have that percentage. So I look for that percentage first. Okay. When I look at these kind of questions. So if they've incurred what? Cost to date of 1.8, and they think the cost to complete here is what? 600,000, then they think the total cost on the contract, the estimated total cost on the contract, at least, at the end of year 2, which is when we're doing this, is 2,400,000. Okay. So we sit there and we say, okay, they think they're going to spend 2,400,000 on this. But so far, they've incurred cost of what? 1,800,000. So based on a cost-to-cost estimate, they are what? Thinking that they're 75% done? Question? Okay. Now, once we got that 75%, okay, we're starting to feel pretty good about ourselves. Okay. Now, they tell us the price of the contract is $3 million. And they tell us that we calculate, I don't know that they told us, but we calculate, gave us information, calculate that what? That the total contract is 2,400,000. So if you take the 3 million minus the 2,400,000, that means they think that they're going to make profit on this contract of 600,000, right? Okay. And since we are what? 75% done, we multiply that times 0.75. That means that we think on the entire contract, we're going to earn $450,000 of profit. But we've already taken what, according to this question? We've already taken, according to this question, where's that number?
300,000.
300,000.
we've already taken, there it is. Income recognized already is 300,000. Good. So if that's the case, and that's the last step in the 4-step process, we have to subtract off what we've already taken. That means that in year 2, we believe we've earned not 100,000, but 150,000. Question?
No.
Question like this on the exam could take you, I'm thinking this is a 3-minute job. Okay, this is one that you wouldn't, throw overboard, too quickly. You'd sit there and you'd work with this to get through it. But maybe, maybe it doesn't take you 3 minutes after you've, practiced with a ton of these, which you will in your homework. Okay, I don't know if I mentioned it before. If you ever want to look up a question that we practice here together in class, you can put that into the search in your software and it'll bring you back the same question. Okay, all right, let's look at question 3. And this one, I'm going to just give you the 2 minutes if there's no questions on the other one. Guys, let me bother you for a second. They really should have getting rid of that phrase. Oh, I probably can't see it with the poll in the way. Go ahead and finish the question. I'll say what I want to say. I'll give you a couple more seconds on it. Okay, good. Excellent work, guys, here. I'm not sure why one person didn't respond. Maybe they're counting. Okay, good. Everybody responded. Huh? Why did I think it was good results, though? Really? Only 54% of us got this right? Come on now. This is an easy question. Come on now, okay? What's going on? Under both percentage of completion and completed contract method, you take the entire loss immediately. And that's going to do what to our income? It's going to, I'm not trying to strike that out, I'm trying to underscore it. That's going to decrease our income under both scenarios, right? Come on, guys. Yeah. Why would you pick something else? Anyone want to, and don't, I know it now, nobody's going to say it because I'm being a tough coach here, but anyone want to venture to say why they would have thought it would have been something else? Okay, that's all right. Okay, now, taking a look, I underscored that under US GAAP part, be advised, remember, we only test US GAAP on the CPA exam. So they really didn't need to call that out. There is no IFRS. That was eliminated starting July 1st. So there is no IFRS on the exam, which is great for us. I mean, IFRS was kind of interesting and it was fun to, kind of like taking a trip to Europe for a while, but, now we don't have to worry about it anymore. So that's actually good for us. Okay. All right, guys, let's go ahead and take a quick break. Matthew, I am going to pause. Okay, so I owe you a Coke some point in time whenever we come back to campus. Please remind me to, start up the recording again.
I got you. I always wonder why you don't just write record there. You always write the time.
Okay, good. Let's go ahead and let's talk about income from discontinued operations. Okay, so what happens here now? Well, now, Jinso, can you call me, give me a call later? Because I'm a little trying to figure out the objective of this course is to get you past the exam. And if you're taking the exam after 1 week of taking the class, I'm kind of wondering what's going on. So can you give me a call so we can talk through that? Not right now, but maybe tomorrow sometime.
Okay.
Okay, good. Let's go ahead and let's take a look at discontinued operations. Okay. And the objective here is that we're looking at a company's financial reports, and they have a segment of their business that they have decided to discontinue. They decided to get rid of it. Okay. So what happens? Users of the financial statements will look at that and they'll want to understand that that piece of the business is going away, and they'll want to see that how that would affect net income separately, because they're getting rid of it. And they're going to look at that piece of the business a little bit differently than they would the part of the business that's going to be continuing. So they tell us, hey, you have to break out the effect that the discontinued operations had on net income. Okay, so they tell us here that discontinued operations are reported separately from continuing operations in the income statement net of tax. Okay, now notice that they tell us discontinued operations may include a component of entity, a group of components of entity, or a business's nonprofit activity. So you can just go ahead and sort of flashcard the notion of what the different segments of a business will be. But let's really take a good look right here. Okay. Items reported within the discontinued operations can consist of, and there's three things here, guys. One, an impairment loss. Two, a gain or loss from the actual operations. Okay. And then three, a gain or loss from the ultimate disposal. Okay. Now they tell us that all of these amounts are taken in the period incurred. Okay. Now, if you take a look at those three items, we can make a mnemonic out of that, which is going to be our what? Our loss from actual operations. That would be L, loss from actual operations. Impairment loss, that would be I. And then we have what? And then we have the gain or loss on disposal, that would be D. So you could what? Flashcard this, the components that make up discontinued operations, loss from actual operation. And I know that they put gain or loss from actual operation here, but look, on CPA exam questions, it's always that the operation is losing money, and that's why they're deciding to get rid of it. And that sort of probably holds true to real life as well, as nobody gets rid of a part of the company that's contributing to the contribution margin. So the chances that they'd have a gain and then get rid of it are unlikely, even in actual. And on the CPA exam, it's always losing money. Okay, so you can use this mnemonic LID to remember the components of discontinued operations, and we're going to take those amounts in the period in which they occur. What CPA exam questions like to do is tell you amounts that are going to be being taken in future years, and they're going to try to trick you into thinking that that should be taken in the current year. No, we take these amounts in the period in which they occur. Okay. Okay, now as we're considering entities for the discontinued operation presentation on the income statement. It's going to be parts of the company that we have already gotten rid of, or we have them classified as held for sale. Okay, so you either got rid of it during the year, or you're going to get rid of it relatively soon. You have it classified as held for sale. Okay, now you come over and we take a look at discontinued operations calculation, type of items included, and we already know that it is going to be what? The results of the operations of the component, which is going to be the loss on operation. Okay, that was the L in lid. We have the what? Impairment loss. That's the what? I in lid. And then we have the disposal of the component. That's the D in lid. So it doesn't list it in order, but the disposal, the loss on disposal, we'll call it disposal loss. So it comports to the mnemonic lid, right? What we're really doing here, though, is talking about the impairment. Okay, so what we will do at the time that we are deciding that we're going to include this segment in our discontinued operations section on our income statement, we'll look at its fair value versus its book value of that particular component. And if the fair value is falling below the book value, we will need to take an impairment loss. We will write it down, and that impairment loss will sit there and be included in the section pertaining to discontinued operations. So let's say we have a segment and the segment has a fair value of $1 million and a book value of, say, and I'm just making these numbers up, obviously, 600,000. So we have impairment here of what? 400,000. And we would take that in that period. Now, let's say we don't get rid of it in year one. It's not finally until year two that we're going to get rid of it, and it comes down some more. Well, if that's the case, then we would continue to write that down until we finally get rid of it. Now, they tell us, well, what happens if between your initial write down and the period that you finally dispose of it, what if it comes back in value? In fact, what if it comes back in value in excess of $1 million? Well, you can write it back up to what? You can take a gain for that 400,000 and write it back up to the million, but you stop there. I don't care if your analysis tells you that the fair value is 1.2, you can only write it up to the previous fair value that it had, or the previous, you know what, guys, I reversed my bad. I'm still thinking about that appropriation entry. 600,000 is the fair value, and the book value is what? Is $1 million. That's the impairment loss, not the other way. The fair value is 6, the book value is $1 million. I have impairment loss of 400,000, and if it increases, I can write it back up to what? Write it back up to the $1 million, but I'm capped at the $1 million. I cannot write it up past that $1 million. Okay, so go ahead and flashcard that. Okay, when you have a write down, you take that loss, you can write it back up, but not in excess of the previously recognized losses. Okay, once you are reporting something in the discontinued operations section, you are required to stop depreciating that asset. And think about that. Depreciation is an allocation of future economic benefit of an asset over time. And if we've sat there and we're saying, hey, we're getting rid of this, then there is no future economic benefit and there is no need to continue to depreciate that asset. Okay, now you come over and in the presentation and disclosure section, okay, the results of discontinued operations are shown net of tax and reported separately as a component of income. Now think about that for a minute. Going back to the beginning of this chapter, we had what? We had operating items, we had non-operating items, we had tax, and then we reported our income from continuing operations, right? So we've already reported our tax expense for the period on the income statement. When you get down to the discontinued operations, now you're going to start reporting those things net of tax. You will continue down on the income statement. You'll have the discontinued operations section, and you report the gain or loss from discontinued operations. Now, when you must, by the way, flashcard that, and flashcard that you must disclose in the notes or on the face of the financial statement, okay, the amount of the actual loss from disposal. So when you finally dispose of that thing, you have to either put it on the face of the income statement or in the notes of the financial statements what the actual loss on the disposal of that segment was. Okay. Now, sounds like a lot of rules there, and it is, and we flashcarded those, but let's just go ahead and take a look at this example. And you have the golf division of all sports here has been losing money on a monthly basis. The golf division's income statement accounts are also presented below. So you got the entire company, you got the golf. We're really going to be focusing here. The board of directors decides on April 30th, year one, to dispose of the golf division. The carrying value of the golf division on April 30th is $4 million. Its fair value less cost to sell is 2.2. After months of negotiation, the division's net assets are sold on June 30th, year two now, for $2 million. The golf division was continuing to lose in year two, $200,000 per month. They give us the income tax rate because we are going to have to report this stuff net of tax and assume all sports income from continuing operations is $487 and 5.2. Now look, guys, I don't care about the continuing operations part. All I care about is how we're going to handle the golf division. I'm staying focused on the fact that we're talking about the discontinued operations here. Okay, so let's just go ahead and let's take a look down here. Okay, and I want to figure out what I'm supposed to report down here in the discontinued operations. I know they gave me the information for the the continuing operations, but we're focusing on discontinued operations here. Now, the other thing that's annoying about this example is they kind of want you to sit here, and I guess they're treating it like a whole simulation where you take the revenue minus all the expenses here, and that would allow you to then come up with what the income was for the period on this. More likely, questions are just going to tell you, hey, look, after you've looked at everything, they're losing $2.4 million a year from the operation of this. Okay, so if they're losing $2.4 million a year, that's the what? That's the L lid. That's the loss from operation. But I have to report that net of tax. Now, the way you get the net of tax is you take 100% minus the tax rate, net of tax, that's what? 60%. So 60% times the 1.4 means that I have the loss from the operation of 1.4. The I lid says what? I have to come up with the impairment loss. Okay, so what's the impairment loss? Well, when you look at this thing, they told us that it was what? Had a book value of 4, but its fair value was what? 2.2. So we have an impairment loss here of 1.8, but again, we take that net of tax. So you take the 1,800,000 times the 60%, and now we have what? Now we have the impairment loss. We have the I lid. We have the L lid. We have the I lid. Now we're doing year one here, and since we haven't disposed of it yet, there is no disposal loss. So you're not going to have the D lid until you actually dispose of that item. So you take a look, and they have the what? They have the 1,400,000, the 1,080,000. When you add those two numbers, those two negative numbers, you add them together, you get a total, someone check my math on this, of 2,520,000. Is that correct?
I'm checking now.
Huh?
Yes.
Okay, that 2,520,000, I want you to put down here, could be reported as one amount. That's it, could be reported, that says as one amount. 2,520,000 could be reported as one amount. Okay, you don't have to list them out separately, huh?
I got a question. I noticed the depreciation expense was one of the items they took out, but didn't we say earlier that unless the stopping of the depreciation of something is just if you're disposing of an asset?
Well, apparently they must have stopped depreciating it on April 30th, right?
Well, it says year one, 495. So.
But they didn't decide to get rid of it until April 30th, year one. So they could have continued to depreciate it up until that time.
Okay.
Okay. But the important takeaway here is that the entire results of the operation for the entire year are down in the discontinued operations section.
Right.
Yeah. So that users can look at that, right? It's everything they lost for the year. It's the loss from the operation, which I presume there they must have depreciated that up till April 30th, and they don't make you reverse that out. Okay. At that point, it's just that you stop depreciating it. And then the impairment loss, and as I'm putting here that amount in parentheses, you don't have to call out each element. On the exam, they'll probably ask you, what would be the loss? What would be the loss from discontinued operations in year one? And most likely, you know, they're not going to ask you the separate numbers. They're going to ask you that number as the question answer. That's part of the reason I'm pointing that out. Okay. All right. Now we go to year two. And in year two, notice we take year two losses in the period in which it occurs in year two. They said they continued to lose 200,000 a year for 6 months. Okay, so 200,000 a year for 6 months is 1.2. But again, we report that net of tax. Okay, so what happens? We sit here and we take that 1.2 times 60,000. I mean, not 60,000 times 60%. That's 720,000. Again, don't worry about this. I wish they wouldn't have distracted us with the continuing operations. I guess they just want you to see where it is on the income statement. It comes after discontinued. It comes after continuing operations does discontinue operations, and it's net of tax, right? And then they finally lost on disposal. And just to remember, the division, okay, golf, whatever, started out and it was at 4. And then we took an impairment of what? 1.8. So at that point, it was being carried at what? 2.2? Right? After we took the impairment?
Yeah.
Okay. And now they're selling it for what? Now they're selling it for 2. So if it had a carrying value of 2.2 and now they sold it for 2, we've got a loss on disposal, right? And that, guys, is the D in lid now, right? Okay. The loss on disposal of 120,000. And of course, that 120,000 is after you consider the net of tax. So they put that there. Okay. And so you have this now, 720 plus 120 is what? 840? Negative 840? Yeah. right? Okay. And again, you could report that as one amount. However, the loss on the sale of disposal must be disclosed. So you could show it like they're showing you right on the face of the income statement. If you just show this as one amount, then you still have to disclose this 120,000. Question?
Or are you saying if they show it this way, they wouldn't have to disclose it because they did separate that as a line item?
Well, technically it is being disclosed. It's being disclosed on the face of the financial statements. So I should probably say must be disclosed, which is correct. It could be in the footnotes as well, though.
Gotcha. I see what you're saying.
Yeah. Okay. Okay, good. Let's go ahead and let's look at this question. This is really, this is to me, this question summarizes the whole thing right here. This is a good question. So I'll go ahead and pull you up here. Okay, looks like we've got a pretty good response here. So good, we've got pretty much everybody getting this right, and that's highly unusual. So I'm wondering what's going on there. I'm upset when everyone doesn't get the right answer. I'm upset when everyone does get the right answer. So there's no pleasing me, right? Okay, but let's go ahead and let's take a look at this. Okay, and we have this question, and when I read the first sentence here, I'm like, uh-oh, I've got to discontinue operations because they're selling the assets of the entire division, right? So when I know I have a question asking me discontinued operations, I'm just going to go ahead. I know I'm going to have to pick out different elements of lid from this question, and I know that I take the amounts in the period in which they occur. So I just have to figure out what elements of lid are in here and what period I take them in. Okay. So they come through and they say the sale was completed on January 15th, year 4, and resulted on a gain of disposal of 900,000. Okay, well, there's my D in lid, and I'm just going to put that in the period in which it occurred, 900,000. that first paragraph is what I'm applying here to a large extent, right? Hart's operating losses were $600,000 for year 3. Okay. I don't argue with the question. I take the energy of the question. I use the ninja approach to answer the question. Remember, guys, we've got 1.5 minutes on average per question, right? So we're looking for ways that we can, routinely do these questions, and we get better and better and better at that. That starts to save you the time, or that gives you the time you need to be successful on the exam, right? The sale was completed, $600,000 in year 3. And they lost $50,000 you take the amounts in the period in which they occur in year 4. They don't talk about any impairment here, so I'm not going to have to worry about impairment here, the I in lid. But then I look, and of course, they tell me disregard income taxes. If they gave me an income tax rate, then I'd have to sit here and calculate this net of tax. But when you look, then we have what? We have an $850,000 gain in year 4, $600,000 loss in year 3. I'm speaking to a group of people in which every single one of you got it correct. Okay. Question? Okay, good. Let's take a look at the next module, which is accounting changes. Okay. Now, when we talk about accounting changes, and then we'll talk about error correction, okay, there are really 3 types of changes they're going to talk about. They're going to talk about change in accounting estimate, change in accounting principle, and change in accounting entity. Okay, so those are the 3 changes we're talking about. Okay, now change in accounting estimate is pretty simple. They tell us we have prospective application, which means there will be no restatement. Prospective application means we go forward with the new estimates. So like I was saying earlier, Matthew, when I was saying, hey, if you have a change in estimate, you don't go back. Because if you did, 10 out of 10 years, you'd have to go back and change something, because you make your best estimate, you put a footnote on the financial statements warning the users that there's the risk estimation uncertainty, the risk that your estimates won't be correct. And everyone lives with the fact that there could be differences between what you're putting down today and what's going to happen in the future. So you just go forward with that new estimate. Okay. Good example, change in the life of an asset. Okay. So let's just come down and let's just go straight to this example. So what happens? We buy this truck for $90,000. We think it's going to have a 10-year life. There's no salvage value. So when we calculate the depreciation for years 1 and 2, it's $9,000 for each of those years. So if the original cost was $90,000, and we've taken what, $9,000 for year 1, $9,000 for year 2, at the start of year 3, it has a book value of $72,000, right? Okay. Now they tell us that during year 3, very important here, guys, because you're looking and you're maybe not focusing as tightly as you would when you're working a question. They don't tell us when in year 3. They don't say at the beginning, at the middle, at the end. Doesn't matter. I don't care if it was the last day of the year you come up with a better estimate. You use that estimate to calculate your accounting, whatever you're doing, in this case, depreciation for the entire year. So don't get locked into something that says on October 1st, they found out, and then you start using the old estimate for the first, whatever that be, 9 months of the year. And for the last 3 months, you start using the new estimate. No, you use the new estimate to calculate whatever you're looking at for the entire year. Okay, so since they now have determined that it really only has a total of 5 years, well, what's happened? Well, total of 5 years, but I've already taken year 1 and year 2, haven't I? So now I've got what? 3 years left. So that's what I use to calculate my depreciation. The last 3 years, I don't go back. I don't restate anything. I just go forward with the new estimate. Okay. Okay, now flashcard this up here, and this is a little bit irritating, but go ahead and flashcard this, okay? Changes in accounting estimate that are inseparable from a change in accounting principle should be treated as a change in accounting estimate, okay? Now this is annoying because we don't have the installment method anymore. So they should get rid of this example. Do you think Becker likes to hear from me? So, take that out. That's ridiculous. They should have got rid of that because there is no more installment method, okay? But what they're saying to you here is, hey, let's say you're looking and you're using a certain accounting method because you don't have a good way to estimate what your losses are going to be or something. And then you get better information later on. Well, and so now it allows you to use a different method. Well, is that a change in accounting estimate or a change in accounting method? They're telling you that's a change in accounting estimate and treat it as such. Okay, I got a better example. Here we go. Thank you, God. Thank you, God, for giving me a better example. Okay, for example, let's say I'm using declining balance depreciation to depreciate my asset. So if I'm using declining balance depreciation method, I'm telling you, hey, I think this asset depreciates quickly in its early years and more slowly in its later years, right? And let's say I depreciate it that way for 3 years. Then after, 3 years, I say, I'm going to switch to the straight line because this asset actually depreciates evenly over its life. Well, is that a change in estimate or a change in method? Because I did go from what? Declining balance to straight line. And then, the standard said, we're going to tell you right now, okay, since you accountants are beating each other up over this, we're going to tell you that's a change in estimate. Okay. Okay, good. Now you come over and, but there is no more installment method, so they should get rid of that example. Okay, now we say that change in accounting principle is handled prospectively, meaning do not restate. We don't go back in that example to years, 1 and 2 and say, oh, it only had a 5-year life, so the depreciation should have only been whatever 90,000 divided by 5 is. No, we just go forward with the new estimate. Okay. Okay, good. Now you come over and as that change in estimate is working its way through the financial statements, you should continue to disclose that you had that change in estimates. So you will disclose it in that little example, obviously in year 3 that you had a change in estimate, but you should probably continue to, in that example, disclose that in year 4, year 5 that you've had this change in estimate dealing with your depreciation of that particular asset. Okay. All right, good. Change in accounting principle retrospective application, okay? Retrospective application is a word that FASB made up, a phrase that FASB made up to describe what's going on here, okay? Because I see things, and by the way, be careful with that Facebook. Be careful getting advice from amateurs on Facebook, okay? But I see things where people will sit there and they'll say, oh, ho, What on earth is retrospective application? I've looked all over the internet and I don't understand it. Okay. All we're saying is FASB made up a phrase to describe this process. Okay. And the process is that if you have a change in accounting principle, you are to restate any prior periods presented, and you are to calculate a cumulative effect of accounting change and report that as an adjustment to the beginning balance of the earliest period presented, the beginning balance of retained earnings of the earliest period presented, and that adjustment is made net of tax. That's what retrospective application means, period. There's no other thing that it means. It is the phrase that FASB came up with to describe the process that I just described to you, that I just spit out to you, okay? Now, notice in there was the word restate. We restate any prior periods presented, but FASB didn't want to call that a restatement process because in the accounting world, restatement is a dirty word. Restatement means that I screwed up and I have to fix something now. Changing your accounting principle, although it shouldn't happen every day, is something that could be justified, and the company could be justified in that. You're still going to restate any prior periods presented. Don't call it that restatement, call it retrospective application. Okay. So it gets confusing because you see questions in which they ask you, well, what should you do if you have a prior period, a change in accounting principle, and you sit there and the answer is, well, you have to restate any prior periods presented, but then they ding you for calling it restatement because you're supposed to call it what? Retrospective application.
So am I correctly understanding that the cumulative go back is to all prior periods affected? So if you're taking over the books for a startup company that has not done a very good job of following GAAP in a certain thing.
Whoa. I got to slam on the brakes right there. If they haven't done a very good job, then you're telling me they made an error. That's not what we're talking about. We're talking about a company that has sat there and decided to change from one acceptable accounting principle to another.
Oh, okay. So this is just GAAP. Oh, this is GAAP to GAAP. Okay, sorry.
Yeah, GAAP to GAAP, from one acceptable accounting principle to the other. If it's an error, Kathy, what's interesting is I'm going to follow the same process, but I give it a different name. Instead of calling it retrospective application, I call it restatement then, because now they are restating because they screwed something up.
Got it.
Okay. All right. So let's just take a look at a couple things here, guys. And I'm going to give you an example that I think I'm hoping will be helpful here. A little example that I came up with, and we are going to go GAAP to GAAP. And the reason we're doing this is because we have decided that the rule that we're changing to, the standard that we're changing to, is preferable over the old method that we were using. So it is going to show the net position of the company, their income better. And that's why we're changing. Okay. They can't come to, an auditor's not going to sign off on the change if they came and said, auditor over here, I heard we could get a better net income if we do this. Is that true? Because that's why we want to do it. No, they have to be saying, hey, look, we've looked at this, at least have to talk the talk. We've looked at this and this is going to be a preferable way of presenting things. Okay. Okay, good. Now we come over and let's take a look at what they tell us about this cumulative effect. Okay. And when we look at the cumulative effect, okay, it will manifest itself differently if we're dealing with non-comparative statements versus if we're dealing with comparative statements. Okay, So let's first look at what happens if we're talking about non-comparative statements, okay? If non-comparative statements are being presented, non-comparative means what? I'm just showing you the results of 2020. That's it. I don't show you 2020 and 2021, right? So that's non-comparative statements, okay? Then the cumulative effect of a change in accounting principle is equal to the difference between the amount of beginning retained earnings in the period of change. I'm assuming we changed our accounting principle in 2020 in this example, and what the retained earnings would have been if the accounting change had been retroactively applied to all prior periods affected. Wow. That means that if I sat here and I changed my accounting principle in 2020, and I've been in business since 2000, I've got to work myself through 20 years of the effect of that change and report a cumulative effect adjustment to the beginning retained earnings of the only period presented here in non-comparative statements, which would be 2020. Now, if comparative statements are being prepared, and just for comparative statements, now I'm showing you what? 2020 and 2019 side by side like that. That's comparative statements, okay? If comparative statements are being presented, so those would be the non-comparative. Let's do that. These are the comparative. Okay, if comparative statements are being presented, then the cumulative effect is equal to the difference between the beginning retained earnings in the, they say the first period presented. I like it better to say the earliest. I'm squeezing in the word earliest period presented. I don't like the first period presented. The earliest period presented, and what retained earnings would have been if the new principle have been applied to all prior periods. So now the cumulative effect, if I change in 2020, and I have I have comparative statements comparing 2020 to 2019, I'll use the new standard to prepare my 2020 statements, and the cumulative effect adjustment will show the difference in what the retained earnings would have been if I had retroactively applied the change. And I'll use the new standard to prepare the 2019 statements, by the way. And then the cumulative effect adjustment will be what? If I had used the new standard in 2018, 2017, 16, 15, all the way back to 2000. Okay. Okay. And it is presented net of tax as an adjustment to the beginning retained earnings of the earliest period presented in our stockholders' equity section of our balance sheet, net of tax. Okay. And that would be 2019 in our example. Now, you take a look at e-learning, which is on my screen right here. Okay, and this is why I was kind of panicking before class with the IT folks, because I'm like, oh, I need to get into e-learning to show you guys this. Okay, so when you come over under chapter 1, you have this chapter 1 cumulative effect example. See that? Okay, now I'm going to go through this with you on the screen, but I just want you to know it's there. Okay, but you can see it here on the screen, guys. It's a little hard to see, so please make your your screen as big as possible. And unfortunately, you might have to do one of these. I'm somewhat limited on what I'm able to do here with this, just so you can see everything. Okay, but let's just take a look at this. I'll try to make it a little bigger. I think I got a little more room here, but anyway, let's look at this. Okay, and I'm just going to go ahead and highlight it as I go. No, stop giving me advice. Okay, so company X begins business in 2018 using completed contract method, meaning they're not taking any profit on these contracts until they are done with them, right? In 2020, the company changes to percentage of completion method. No income was recognized in 2018 and 2019 since no contracts were completed, right? We don't take anything under the completed contract method until we're done with those contracts. Now, net income would have been 100,000 in 2018 and 200,000 in 2019 had the percentage of completion method been used in those years. Net income is, and for some reason my pens are going to crap out on me. Here we go. Net income is 400,000 in 2020 using percentage completion, and 50,000 had the company continued to use the completed contract method in 2020. Prepare the 2020 statement of retained earnings section in the statement of stockholders' equity. Okay. Now, let's go ahead and let's first look at non-comparative statements. Non-comparative statements, I'm just showing you what? I'm just showing you 2020. Okay. And since I haven't had any income in my first 2 years of operation, 2018 and 2019, obviously the beginning balance in retained earnings is 0, right? And what I do is I go back and I say, okay, what is the cumulative effect of the change in the accounting principle from the previous periods? And by the way, guys, I'm ignoring income tax here. I'm ignoring income tax as we report all this net of tax, don't we? I'm ignoring the income tax here, okay? And so what happens? Well, if the income would have been 100,000 in 2018 and 200,000 in 2019, that's what? Those 2 years, 100 plus 2, means that my cumulative effect adjustment is 300,000. What my income would have been in 2018, 2019, had I used percentage of completion. So versus 0, it would have been 100 in 2018, 100 in 2019, total 300,000. And that's the adjustment. Okay. So that now gives me my restated balance for my retained earnings. Okay. And then what happens? Now I come over and I give my 2020 net income using percentage of completion. And that gives me my ending balance of retained earnings. So the cumulative effect, notice, does not consider anything that happened before the year, anything that happened in the year of change, excuse me. It only considers things that happened what? Before the year of change. I use percentage of completion to calculate my net income in 2020. I gave you the difference for 2020, what it would have been between percentage of completion, the 400,000 completed contract, the 50,000, but I did that so that you know to ignore it. Because the question will do that. They'll give you that. That is not part of the calculation. No, the difference between what reported income is under percentage of completion and the completed contract in the year of change is not part of the cumulative effect calculation. It's everything that happens what? Before the year of change. Okay. Now let's just look at how we would apply this now in comparative statements. Okay. And if we have comparative statements, now we're showing you 2020 and 2019. So now the only period not presented affected by the change was 2018, right? And the income would have been what? Would have been 100,000 in 2018. So again, I start with my beginning balance, which was 0 because I hadn't taken any income in 2018. I bring in the cumulative effect, which is what I would have taken as income in the period before the earliest period presented, which is 2018 here. So I add that to 2019. I now have the restated, and then I restate my 2019 statements, and it's going to show net income is 200,000 because I said that's what it would have been if I had used percentage of completion in 2019. So there's my net income of 200,000. I mean, yeah, 2019 of 200,000. Thank you, God. There it is right there. I think I said 100,000. There's the 200,000 net income for 2019. And then I have the ending balance of 300,000. And then when I go to 2020, I have a new beginning balance for my retained earnings of 300,000, and I simply use the percentage of completion method to prepare my 2020 statements. There's the net income for that. And notice what? The ending balance in retained earnings is the same regardless. Okay, so then I turn this into a set of questions. What would have been reported as a cumulative effect change in accounting principle in 2020 of non-comparative statements? 300,000. What would have been the cumulative effect change in accounting principle in 2020 if comparative statements are used? Tricky question. The answer is 0, because I deal with the cumulative effect adjustment in the earliest period presented, right? What would be the cumulative effect adjustment in accounting principle in 2019 if comparative statements are being prepared for 2019 for my comparative statements being prepared in 2020? The answer is 100,000. Question. Is that one of those, I don't want to ask a question because I'm going to figure it out later silences, or is that I don't have a question because God just came down and told me that I understand this?
No, I personally, I can follow this as you walk through it. It makes sense. We'll see when I get to the actual questions.
Yeah, well, that's always the rub. But I think, Matthew, what will happen is if you understand this, and thank you for being honest with it. If you understand this, then you might not get the question right. But I think then as you look through the explanation, you can kind of pin it back to this, what we've said, is the way you're supposed to do this, right?
Yeah, that's typically how I just do it.
Yeah, and that's fine.
So I just want to make sure that I understand what happens when an accounting principle changes. For example, there is newly issued codification, as there was a couple years ago with respect to leasing. So then accounting departments basically had to go back and restate, like if they had a bunch of 5-year leases, they had to go back and do this exercise for all of their 5-year leases to show the cumulative effect of the change?
Well, two things, and I'm not sure what FASB said in this case. Often FASB waives this.
Oh, okay.
For changes.
That would make people cranky.
Yeah, so often they waive it. But sometimes they call it out and say it is subject to cumulative effect adjustment. And then the answer to your question would be yes.
Ugh.
Yeah, I don't know what they did in the case of the leases. That
okay.
I don't know.
All right, but the potential is there unless they do something otherwise.
There's one, if there's no question about this example, can I go back to the text first now?
Yeah.
Guys, we're good? Okay. So when we go back to the text, okay, there is one more way out, okay, which is and I'm not going to go through that example because I gave you another example, which is the impractical to estimate provision, okay? And so what that exception, whatever. So what that says, that if it is considered impractical to accurately calculate the cumulative effect adjustment, then the change is handled prospectively like a change. So they don't make you go through that retrospective nonsense, interesting process if you're sitting there and you determine it's impractical to estimate. And then they give us an example of something that would be impractical to estimate. And guys, I'm going to ask you to include in there that example because, and they need to get rid of these US GAAP references because that's all we test now on the exam is US GAAP. But if you look, include that on the flashcard too, because I've seen questions that call out this example. Therefore, I think it means that FASB must have included it in the standard, or this is actually the accounting principle board came up with all this. The APBO opinion that covered this probably called out requirement here of LIFO as an example for this requirement. Because think about it. If I change my inventory method and I change from any other assumption to LIFO, what am I saying to you? I'm saying that the stuff that was first in, first out is actually still here. So I've been accounting for this stuff as though it's cost of goods sold all these years. Now I'm saying last in, first out, I sold you the new stuff first and the old stuff is still here. Meanwhile, they may not have the accounting records that allow them, if you're Macy's, to go back to 1800 something and say, well, this is the stuff that used to be here, you know, that now I'm saying is still here. So they put that provision in there. So now, shoddy record keeping, laziness, cost benefit analysis is not being suggested here. What's being suggested here, it's impractical to estimate. So you can't sit there and tell your auditor, well, you know, I have a hangover, so I can't figure this out. You're going to have to show them that you've made a good faith effort to try to come up with what the cumulative effect adjustment is, and it is impractical, meaning almost impossible to estimate. Okay. Okay, good. Again, guys, change in depreciation method, okay, is considered both a change in accounting estimate and a change in accounting method, and therefore it should be treated as what? Change in accounting estimate and handled prospectively. We said that generically, and we're saying it specifically here now for depreciation method. Then I gave you an example with depreciation method in it. Okay. Okay, changes in accounting entity. I want to wrap up the changes part here so that this module is clear for you to jump in and start doing homework. So I'm hoping we don't go over, but I'm worried that if I don't finish it tonight, then you can't really have, you know, a chance to really feel comfortable about module 6. So I want to go ahead and wrap this up. Okay. So change in accounting entity retrospective application. What does that mean? That means that we're not calling it restatement, but we're going to follow the same process that we said before, that if you have a change in accounting entity, you will restate the statements of any prior periods presented to reflect that change in accounting entity, and you'll make a cumulative effect adjustment to the beginning retained earnings of the earliest year presented as though you had that entity that you're now have changed to. Okay, so under US GAAP, change in accounting entity includes consolidated or combined statements that are presented in place of statement of individual companies. Okay, let me tell you a quick little story here. Okay, I had a student probably this time of night, probably a little later than this, all of a sudden called me up. Hey, John, I'm your former Becker student. I have a question that maybe you can help me with. Okay, what is it? I passed the CPA exam. Oh, great. Yeah, I'm working now. And I have this client that last year prepared unconsolidated financial statement. They just reported the financial statement of one company. This year, they're going to now prepare consolidated statements and pull in companies, and they want to report that as one company. I just finished the consolidation for the current year. What should I do with last year's statements? And I'm like, well, you have to restate those. You have to consolidate those statements too, so that you can compare the 2 years. All I heard was silence on the other end. Why? Because the person had probably bludgeoned their way through the consolidation all day. And now they're sitting there and they probably have a deadline, and they realize that now they're going to have to sleep tonight, right? Because they're going to have to sit there and now also consolidate the previous year. Okay, so when that happens, okay, change in accounting entity occurs. Let's go ahead and take a look at the bad news here. All previous statements that are presented in comparative statements along with the current year should be restated to reflect the information of the new reporting entity. In other words, you got to consolidate all the companies in. You got to go back We don't call it restatement, but that's what it is. You restate the prior years, and you use retrospective application to do that. Okay, now you come over and we talk about error correction, prior period adjustment, and the rule is going to be the same. Only this time we put the word, the R word on it, restate. We actually say restate because now we made a mistake and we're fixing the mistake. Okay, so let's just take a look at the error correction. Okay, what we should be doing here for the error correction. And let's just take a look at the next page. Okay, and if comparative statements are being presented, correct the information if the year is presented. Comparative statements are presented and financial statements for the year with the error presented, merely correct the error in those prior period statements. Adjust beginning retained earnings of the earliest year presented if the year affected by the error is not presented. Does that sound familiar? So if the error was made in 2018, then we'll make a cumulative effect adjustment to what? To the beginning retained earnings of 2019. If the error was in 2019 and we're presenting 2019, then simply restate 2019. Okay, and if comparative statements are not presented, then we're going to have a cumulative effect adjustment to the beginning retained earnings of the only period presented. Same thing we do if we have change in accounting principle and we have non-comparative statements, but now we put the label on it, what? Restatement. Okay. Okay, good. Now you come over. And guys, you don't have to look at that exhausting example. All I want you to look at is where you're going to report these cumulative effect adjustments. Okay, so we have what? We have the prior period adjustment. We have the cumulative effect adjustment. Okay, and notice, guys, they first report them and then they are reminding you. You don't have to necessarily disclose it like that, the income tax effect, but notice they adjust it just like I was showing you in the little example that I made on the Excel spreadsheet. It's an adjustment to the beginning balance of the retained earnings. Then you have the restated balance. And then it's like any other statement, retained earnings are bringing the income for the current year, less dividends. We'll have a whole discussion on stockholders' equity in later chapters. Okay. All right, let's look at a couple questions. Any questions on that before we get to the questions? Right, it's already 8 o'clock. So let's just go ahead and I'll tell you what, let's go to the model of doing these together just to save us a little time. We don't have to save time on the poll. So per US GAAP, which of the following statements is correct regarding accounting changes that result in financial statements that affect the statement of a different reporting entity? Now think, we have a flashcard that says we have change in accounting entity, don't we? And when you have change in accounting entity, what are you supposed to do? You're supposed to restate the statements of any periods presented, aren't you? Wasn't that the rule? Yep. Even though we don't call it restatement, technically we call it retrospective application, right? Okay, so let's just take a look. Cumulative effect adjustment should be reported as a separate item on the income statement. No, the adjustments are going to go to what? Retained earnings, aren't they? They don't hit the income statement at all. No restatements. No, we do restate. We don't call it restatement. We call it retrospective application, but we do restate. No restatements. No, we do restate. The financial statements of all prior periods presented should be restated. Yep. That's why it gets confusing, guys, because you say, but you said it was retrospective application. Yes, I did. The method, they call it what? Retrospective application. The technique is restatement. The action is restatement. It's a small r. Okay. All right, good. Let's take a look at number 2. So it's a noun. It's a Now I'm going to get into English. It's a verb rather than a noun. Never mind. Okay, number 2. For year 1, Pack Company estimated its 2-year equipment warranty cost based on $100 per unit sold. Experience during year 2 indicated that the estimate should have been, do I hear a change in estimate coming? Okay, should have been 110. The effect of this $10 difference is going to be reported in year 2 in income from continuing operations. I'm looking at that, I'm like, huh? Let me keep going. B, as an accounting change, net of tax? No, we go forward. We don't treat that as an accounting change, net of tax. No, we're just going to use that new estimate in the new year, aren't we? As an accounting change requiring year 1 no to be restated? No, we go forward. Correction of an error? No, it's not an error. We go forward. So what will happen? We'll use the estimate in year 2, the new estimate in year 2, and it'll affect year 2's income from continuing operations. So there are questions where I think eliminating the wrong answers can get you, you know, some mileage as you go through. Question.
Yeah, something that kind of came up today when we're doing the homework. I know you're checking them more often than you were in prior classes.
Mm-hmm.
Some of the task-based simulations revolve around material that's not covered until later in F1, for example. If we happen to skip those because we don't know the information yet, is that fine to come back to them later?
Well, I would say that I'm a little confused because don't they list out the task-based simulation by module?
They do, but somehow
they start creeping in other things.
Yeah.
I mean, do the best you can, and if there's some stuff there that you don't understand, or there's an entire, you know, task-based simulation that is unfairly leveraging off of stuff we haven't covered yet, and you don't work that, I'm not going to come and kill you. You know, I am again looking for progress on those, not perfection.
Gotcha.
Yeah, sometimes they do that, and I used to get on them about that. Not so much on a module basis, but I used to get irritated when they put a task-based simulation that was contemplating knowledge of something that was going to come until several chapters in the future, because it was, you know, I was afraid it would destroy the confidence of the students, but I gave up on complaining about things like that.
I think they did that in auditing at one point, and I think I emailed them about it, and that's how I knew that they said, yeah, it happens.
Yeah. The problem is that they have a network of people that are preparing different pieces of the material. And, you know, some of those people have never spoken to each other, let alone get into the same room to talk about some things that they're piecing together. And when you have things like that, you're going to have, you know, situations like that happening. So it's not perfect. Okay, questions, concerns? Okay, guys, good work. We will pick up module 7. I know we're a little bit behind, but the good news is you've got plenty of time to catch up your homework all the way up through module 6 now, and then we'll jump into 7 here on, and then we'll get into chapter 2 on next Thursday. All right.
Thanks.
Thank you.
Okay, guys.
Professor.
Have a good night.
Professor, are you going to post on e-learning to be able to download the extra credit for the pictures for Ascend?
Yeah, I will. Yeah, I did it in my 100B class, but I didn't get a chance to do it here yet, but I will.
All right, thank you.
Yeah, thanks. Hang on to that picture in the meantime. Don't delete it, but I'll get it up there. Okay, guys, have a good night if there's nothing else.